Dove and Dragon Radio. I'm your host, M.L.Ruscsak, and I'm here with special guests and half of the dynamic duo of How to Retire on Dividends, Brett Owens. Welcome.
Thank you. Thanks for having me.
Now, I cheated. I do have the book right in front of me with the name of the book. But what led you to write this?
Well, ML, that's something we've been working on from our newsletter perspective. So we have an investing newsletter that I write, Tom edits, that we've been walking investors through since 2015. So talking about dividend investing and specifically how they can take a portfolio and just retire on dividends and income alone.
Now, this is a novel idea. Now, anyone that doesn't know what a dividend is basically what you get back on your savings account. I'm going to use very generic terminology. So not all of us have PhDs in finance. Just your interest. That's what you're living on. That's what you need to live on. The rest of it is in your stocks and whatever you're investing in. About right?
That's right. Yeah, exactly. That's the concept. So what you would do if you're interested in this type of strategy is focus on stocks that are paying you something every month or every quarter. So it's kind of like very similar concept to interest, where if the term would be if a stock pays a 2% dividend, that's what your annual cash from that stock would be. So it would, in the old days, they would have mailed you a check. Mm-hmm. These days, it would just show up. It would just kind of drop into your account as interest, like you said.
I'm trying to simplify because, a lot of us, my generation and below, don't understand stocks. They go to the cryptocurrency, they go to the interest in their bank accounts, and that's how they live. So going with stocks that pay you every month or every quarter, whatever it is something our grandparents tried to teach us, and now you're giving us a book on how to do this.
That's right. Yeah, this is a way that we can kind of take the concepts, like you said, that the younger people are doing today to invest, especially with the stock types of things, the meme stocks and things that you can have fun with. Well, you can also have fun with this type of thing, like you said, where our grandparents used to buy something so that it would pay you. These things are still out there and available for us to buy for our retirements or just investing accounts as well.
Right. I think one of the stocks would be Microsoft or Disney, Tesla. Ones that we know the names to are usually the ones that pay you really well in dividends.
Exactly. Yeah. And Microsoft's a great pick because what Microsoft also does every year, like you said, not only do they pay you a dividend every quarter, but they also have a habit of raising that dividend every year. So they'll pay you more and more every year, which is kind of a nice thing.
Yes. My daughter loves her Microsoft. So it's something as a mother I did for her 18 years ago, and it does really well now.
Oh, excellent. Yeah, she must be looking really great on your Microsoft position.
Yes, her Microsoft, her Disney, her Leapfrog. Leapfrog isn't that big, but I had fun 18 years ago.
That's awesome.
When I was trying to teach myself what you wrote a book about.
Yeah, so you've already figured it out. So one of the big keys is if you can buy a stock like a Microsoft, where they're not only are they paying that dividend, but if they're increasing it every year, what you see is that the stock also goes up every year along with that dividend, and you pretty much figured it out 18 years ago. And then you look back today, and you've got this big pile of money.
In theory, is all in her stuff, but that's what we have to do for kids. You have to learn how to do stocks. You have to learn how to do today's stocks, because you can buy a stock on penny stocks or these different platforms today, and they might give you dividends 10 years down the road, or they could just sit there at $1.
That's right. Yeah, if it doesn't pay something today, we don't know if it's going to pay something tomorrow. I always prefer to buy something that's already paying a dividend, even if it's something modest or small, because it's more about how it grows over time. So even if a stock just starts paying a dividend and it's 1% a year or it's 0.5% a year, well, that's our starting base. And then, like we were talking, it can raise like Microsoft did every year, and then you grow the share price along with it. So it's a nice thing to start with something that's paying you, even if it's modest, because that's that's how it goes with investing. If you can just start and get going, then you can snowball from there.
Right? Or you go into your new companies that are starting up or just getting their stock started, and you know that stock's going to take off once it goes into full strength. Unfortunately, you can't go insider trading, but if you kind of watch what the economic platform is, you can figure out your stocks.
That's true. You see a lot of people buying what they know. A lot of folks in e-commerce. I know you do a lot in the e-commerce world, and they saw Shopify early on, where that was a platform they were working with, and this is before Shopify was a public company, and they go public several years ago. And this is something where, to your point, it's not necessarily insider trading because it was available to everyone, the information, but there were people who were working with that platform before Wall Street knew about the stock, and then it goes public. Some of those people were smart enough to buy it. Some of those people were smart enough to hold it, and they're doing very well today on something like Shopify.
Right. You have your Shopify, you have Facebook 20 years ago, you have Twitter how many years ago? There's platforms, even if it's digital or if it's something that we use every day, like Calvin Klein, just different things. If you understand what the economics around you is doing and you have the insight to invest early, you're going to get a better dividend in 10 years.
That's right. Yeah, always better to get your shares earlier than late, because that company continues to grow, like you said. So if you see it's scaling, even if the money is not there yet, you can see these metrics where for Shopify it was stores, for Facebook it was users, for Twitter, right? It was users, where we saw that happening. And then as they grew their user bases, that's when the companies came in and they wanted access, and then they're willing to pay a lot of money to advertise. So right, it kind of grows the whole platform. There's more money going around, and you always get a better deal if you bought yesterday or, like you said, 10 years ago, 20 years ago.
Yeah.
So that's always, as soon as you can see something like that happening and starting to evolve, it's always great to get any position.
Right. And if you have a company that's just starting and they have projections that they're going from this to a $30 million evaluation, you want to invest in that company. You don't want to just say, oh, we're going to do it when they get there. No, you don't want to do that, because now where are you at with Facebook?
That's right. You pay up for it later on. So it's, yeah, exactly. It always gets more expensive. And then eventually you'll hit, there's always that law of large numbers where they kind of hit a ceiling and they have to do other things, or they get into trouble, or people don't like them because they're big. So you do hit that stage. So you always like the earlier days are always the best if you can identify those types of companies.
Exactly. And the early companies is the ones that when you invest, then you can go, hey guys, you want to invest too, or, we want to use this product to your friends, your family. Every person knows 10 people. If you promote that product that you're investing in to 10 people, now you're growing the company's evaluation and growing your own pocketbook.
That's right. Yeah, it's amazing how that can work, and that's what a lot of these companies did with their own to grow their own way. I mean, Facebook. I'm old enough to remember when Facebook came out. I'm kind of hard to believe you are, but I do remember early on where we all hopped onto Facebook because you knew someone who was on it, and in my case, it was people who were still in college who were kind of showing me, oh, this is what we all do now, so we're on here, and that's how a platform like that grew. So that's definitely how it works.
Right. I was working and I was on MySpace. Do we remember MySpace? That was the big thing. And
you were hanging out with Tom.
Yeah.
Yeah.
So
friend Tom.
We're on MySpace, and I have high school kids. Oh no, you don't want to be on MySpace. MySpace is dead. You want to go over here to Facebook. But this is how every stock works. It's 10 people tell 10 people, and that's how companies grow. Doesn't matter if it's Facebook with users or newspaper or a magazine, whatever it is. If you tell 10 people this is what you're using, this is what you want to use, and your affiliate or a stockholder, a shareholder, these are key words. Now you're growing your pocketbook.
Remember Hotmail? They used to have the little thing in the footer. It used to say, and it was something goofy, I think, like, I love you, try Hotmail or something crazy, but it was always there.
And now everyone uses Google.
That's right. Yeah.
Or we use our own three brands through Outlook. How many web services that go through Outlook for the mail? I mean, it looks nice and it has a business mailbox, but it's actually Outlook.
Right. They've got Outlook, and it's up on the web now. So it's all grown up. So not the Microsoft we knew from 10, 20 years ago.
No, it is not. I mean, if you go back to the early 90s, late 90s to today, and you were smart enough to invest back then, you're doing really good with the dividends right now.
Oh yeah. No, those are huge. You see cases. They'll talk about Warren Buffett, the old rich guy from Nebraska. Everyone talks about. One of his famous stories. He bought Coca-Cola, which everyone knows. I think it was in the 90s, so similar time frame, and now every year the dividend, I think it's 40 or 50% of what he paid for the stock, and he gets it every year. So you can imagine giving $100 or investing $100 and you get $50 back every year. That's a pretty good deal. You got to put in a little time to get there, but that is the idea with the Coca-Colas, the Microsofts, and probably someday the Facebooks, Googles. Although you're already looking really good if you bought those stocks early as well.
I mean, you have to have the insight. You have to know how to read a stock ticker. You have to understand where stocks coming from and the companies that they're attached to. I mean, Coca-Cola has how many brands under it? Microsoft has how many things under it? Facebook has how many companies under it? It's not just one company you're buying into, it's 5 or 6.
Right, that's a great point. A lot of people don't think of Microsoft, or they fell asleep on the stock because they think of the paperclip that yells at you and the old Windows errors. But in recent years, to your point, they've done a lot of sort of cloud-based servers where they're kind of like Amazon does, where if you're running a big software company or running a big software app, you might go through Microsoft, and it was a huge booming business that nobody knew about because it was really under the Microsoft umbrella. So everyone thought of the old school Microsoft products. Meanwhile, you have this under the umbrella that was growing like crazy, and that was a big reason why your daughter is so wealthy today. Thanks to stocks like that, your purchase, and then little subunits that grew like crazy underneath that Microsoft umbrella.
And that's exactly what it is. You have to look, where's the growth pattern? Is this going to be a company like Pizza Hut, and they only have one product, but what's their stock at? You know, how many companies do they have under Pizza Hut nationwide or international? You know, you're still getting your money from it, but at the same time, what is their product growing to?
Sometimes it's little, you'll see little innovations along those lines. Domino's did a good job a few years ago where they started investing. I mean, like Pizza Hut, they just do predominantly pizza, but then they started messing around with the phones where they would really emphasize the Domino's app. And if you open the app, it would just order a pizza for you, and then the pizza would show up within 30 minutes. So you will see opportunities like that within sort of these businesses that may look like they're it's same old, but under the surface, you see Domino's has an app, and that's driving a lot of new business.
Every place has an app now. If you don't have an app, you're not getting food. We've seen this in 2020. We have all these restaurants, ones that created apps really quickly, now have these apps and deliver to your door. Well, 2 years ago, they couldn't deliver.
That's right. Yeah. And you see that a lot with retail and retail stocks. And that's something we'd like to write about a lot, where if you're interested in the stock of a store that you would walk into, to your point, you want to make sure they have an app that you can order on, because that's kind of the way that things go. I mean, whether or not you're allowed to walk into the store on a given day, who knows? But you can always use the app to order and have stuff show up at your doorstep. And you want
exactly.
to have their act together.
It's like Burlington versus Walmart. You know, price point is still the same prices, different brands, obviously, but Burlington doesn't have an app that will deliver to my house. Walmart does. So can I go to Walmart today, or do I have to stay home?
Right.
So that's the thing. If you're not able to deliver to your customers, you can't grow.
That's right. And that's where it gets interesting. Walmart, and even a company like Amazon. Amazon was the sort of first to deliver stuff and deliver it fast. But I found in the last year, Walmart.com does a better job of getting stuff. You need toilet paper, Walmart.com. We've had more success getting that delivered to our doorstep than using something like Amazon. So we've been really impressed with Walmart. And it makes sense because they have the stores all over already. And then they just need to get it maybe a mile or two to your doorstep, but they're able to do it. Burlington's not. So that's why you want to stick with the winners. You want to stick with Walmart, where you can order online, or you can go to Walmart. Or I had to buy a Barbie house for our daughter's birthday, and I was able to order it online. I go to Walmart though to pick up the big house, but I don't have to walk all the way into the store. So big time saver. And that's a big advantage for Walmart. That's where they get my order where someone else does not.
And then you also have the companies that will come and assemble that dollhouse for you.
That's right. That's the next step. Yeah, that's
So,
the dream.
I mean, you have to look at your companies, because there's a lot of things beneath the onion or in the layers that you have to dissect to understand how their stock works. And the more layers to their onion they have, the more their dividends are that they pay you.
That's right. It's interesting that sometimes you find that people who invest and they may have more success if they're business people. They may not be financial people per se, but it's kind of an advantage because then you don't get lost in the numbers of what's going on today. Where if you just look at sort of a complicated stock release statement, you can get lost in all sorts of noise. Where if you just take a step back and think about where the business is going, is it getting better? Is it getting worse? What's going on, like you said, beneath the layers? Do they have things in that engine that are going to drive future growth? Or is it something that it was a nice business in 1998 and it's barely hanging on, but really they haven't updated?
That would be Sears and Kmart,
That's right.
Really nice back in the 90s. And where are they at today?
That's right. That's right. And those are the types of stocks, and even some of them paid dividends up until the end, but they got a lot of investors in trouble because they always look cheap, but they were always cheap for a reason, because like you said, they were toast. They were kind of relics of the past, where they just didn't have a place in the modern business world.
Right. They didn't have the foresight to see where they needed to grow at.
That's right. Yeah. They didn't stay ahead of the curve.
And that's where your businesses are. You see, either you're expanding and growing in a time of recession, or you're just shrinking in 10 years and you're not going to be there.
Yeah, and there's almost no business today that you can say is Amazon proof or completely protected. I mean, even pharmacies, which a few years ago you would have thought, okay, well, everyone needs pills. We love our pills here in America. So you would think, oh, pharmacy stocks, they're set to grow forever. And then Amazon releases Amazon Pharmacy, and these stocks kind of get crushed, because that's kind of a scary thing. You may not have to go into a pharmacy anymore. You might be able just to have that.
Yeah, scan your doctor's thing to Amazon Pharmacy and have it delivered to your door. Now you don't have to talk to a pharmacist. You don't have to talk to the sales clerk. You don't have to talk to anyone. Have you taken this medicine? Yes or no? Have you want to talk to someone? Yes or no? You don't have to. And that's kind of scary when you have the stocks that were in Walmart Pharmacy or Rite Aid or Walgreens. We're seeing those pharmacies now closing because, hey, we can get it to our door and not talk to anyone.
That's right. Yeah, we used to have a Walgreens up the street here, and they closed down. And it always struck me as kind of an old school legacy. It reminded me of like a 1990s box store, because you would have things that maybe you would pick them up if you were going in for a prescription. But if you don't need the prescription anymore, then I'm not sure why you need to walk all the way, stumble around the blood pressure machine and fit it with your cash and wait in line and all that stuff, where you can, like you said, just send in your prescription or anything you need on Amazon and have it show up at your doorstep. That's really the future. And that's something Rite Aid was never really able to figure out, is how to get something from the store down the street to your house a few blocks away for whatever reason.
But we're in the digital age. Everything is, can I order it here? And how is it projecting in my pocketbook here? Is it saving me time, gas money? Is it making me money? Because that's a big one. And, what's easier? What's convenient for me? I'm stuck at work. I'm making money passively on my stocks, but I don't have time to go to Walmart pharmacy or Rite Aid. I'm going to just do what I can on the computer, take the 2 seconds, and have it sitting at my doorstep when I get off work.
That's right. Home Depot is another one that comes to mind. They've done a nice job, I think,
Mhm.
during the pandemic. I got a nice little mister, some logs for the outdoor fire pit, and they've done a nice job. They deliver right to your front door and better inventory than Walmart, Amazon. That's an idea where they just really, especially I think with the lockdowns when those started, they
Mhm.
put a lot of emphasis into their supply chain and their
Right.
online experience.
And you see this in their stocks. The ones that actually said, oh, hey, we can do this on an app and deliver to you. Where are their stocks at today versus where they were in March of 2020?
Oh, that's a great point. I mean, a lot of these stocks have doubled since then. So you're talking 100% off of their lows. They can raise their dividend once or twice, but those are definitely the winners since those, like you said, those March 2020 lows. It's been especially those types of companies that have innovated and said, okay, order on the app, order online. We'll get it to
Mhm.
your house. You don't have to sweat it. We're just gonna get it to you, and
Right.
we're the best selection. And you're not going to walk into this retail store you don't want to be in, and then you have no inventory and that type of deal.
Right. I mean, how many go into Walmart right now? What does shelves look like? A lot of them are half bare way because we have a supply shortage because all the ships are parked off either California or New York. We can't get our stuff to the store. But if you order online, they're shipping it from their wholesaler where they're getting it from, and it's coming right to you.
That's right. Target's another one. Target was
Mhm.
always kind of if you didn't want to go into Walmart, that's what Target kind of marketed themselves at. But Target stores are pretty bare now too, so it's kind of tough to make the case for Target. They haven't quite embraced that whole deliver it to your doorstep. They do the online stuff. You still got to go to the store. So they just kind of haven't quite matched everything up to the degree, at least in my experience, that Walmart.com
Right.
has.
It's not there yet. It's
Mhm.
getting there slowly, but
Mhm.
not to compete, unfortunately, where's Walmart and Amazon.
Right. And
And its stocks show it. I mean,
probably need to hurry up. Yeah, I think that's what the stock market's saying. They need to pick
I
up
mean,
the pace.
yeah, we sit here and watch tickers all day, but
Mhm.
my dad used to watch them all day. So yeah, I understand the stock tickers. We see where the stocks are going. If you're not keeping up with the technology, you're going to be left with Super Kmart.
That's
That's
right. Where you're trying to figure out. I remember at the end of Sears's
mhm.
life, they were trying to figure out if what the real estate was worth. That's what it was down to, because there was the business was worth nothing. So then there
Yeah,
were a bunch of stock guys staring at the real estate and trying to figure out what that was worth. It's not really the type of place you want to be if you're a business, having people just picking over the carcass to see what's left.
no, it's not a place to be, and you do not want to be in those stores when they're closed because what's left? I mean, they're actually selling the light bulbs at some point. They
Right.
sell everything they can that's not bolted to the floor. It's why? Because they still have investors they have to pay until the very last day.
That's right. That's right. Well, it will be interesting because Amazon now, I think, is up to about, last I saw, about 50% of all e-commerce stuff. So out of every $2 that gets spent online, $1 goes to Amazon. You have Shopify, who we talked about. They're trying to get a lot of the individual stores up and running.
Hmm.
They've been trying to, I think, help out the bigger box retailer stores also and help them modernize. But for them, it's a lot of internal projects, whether you're Target or Walgreens or Rite Aid or
Right.
Walmart, depends. A lot of that is just in-house. They have to kind of build it and decide that they absolutely need to do it.
Exactly. Now we are almost out of time, and that was a little bleep that they heard pop up. So, where can our listeners and our viewers find you and your book?
Thanks, ML. So for our book, we have a book website. It's called howtoretireondividends.com. So that's where you can find the book. You can download a first chapter. And then we have a daily website where we send out sort of research, stock picks, that type of deal. And we'll cover companies. We'll talk about them from the perspective that we've been talking about, where, hey, this thing pays a dividend, but do we like what the company's doing, or do we not like where they're going in the future? So that website is contrarianoutlook.com, and that's also a free newsletter you can sign up for and get a free daily or weekly newsletter.
Well, this has been very fun and very insightful. So, thank you very much for being on this show today.
Thank you for having me. I enjoyed the conversation.
And for our listeners and our viewers, happy reading. And we're out. Thank you so much for being on the show today.
Awesome. Thank you. It was fun. Appreciate it. Yeah.
And I'll get the review up on Amazon and Goodreads very shortly.
Awesome. Cool. Thank you.
Thank
Sweet.
you.
And then just ping me back. But I got your PayPal stuff and everything, so I'll get you.
Okay. Thank
Taken
you.
care of. Cool. Thank you. Appreciate it. Talk to you soon.
You too.